Hello, everyone, and welcome to the Centre for Ethics and Laws event on institutional investors and investing for the future. I'm Iris Chu, and I'm director of the Centre, and we are very proud this evening to bring you this event anchored by distinguished speaker today, David Rouch of Freshfields, who also led the team in authoring the report, Investing for Impact, produced for the UNPEFI. With him today will be a distinguished panel who will provide comments on investing for the future after David has given his keynote speech. So let me first introduce David Rouch. David is partner at Freshfields Bruckhaus Deringer and has been since 2004. He advises on the full range of financial market services and dealing with some of the market's most prominent regulatory bodies. He has led the team on authoring a legal framework for impact produced for the UNPEFI. And he's also author of The Social License for Financial Markets, published by Palgrave Macmillan last year. He's a member as well of the advisory group of the Oxford University Character and Responsible Leadership in Business. So without further ado, let me give the floor to David, who will provide the keynote address of this evening. Over to you, David.
Thank you, Iris, and thank you very much indeed for organising the event this evening. If it was ever possible to approach the goal of earning a financial return in isolation from society's broader valued goals, that time is not now. The goal of earning money exists alongside wider goals that concern the quality of our social and natural environment, or at least its sustainability. But earning money isn't just a parallel activity undertaken in a hermetically sealed environment. Financial and economic systems can help social and environmental ecosystems to flourish, but they also depend upon and can adversely affect them. They can both strengthen and undermine the systems on which they rely. Investment is part of that. It needs social and environmental ecosystems to flourish if it is to deliver financial returns. Unsurprisingly, therefore, in the face of current sustainability challenges, investor attention to the impact of their activities on sustainability has been growing. But the question of investor impact is also important because increasing evidence suggests that individual investors, echoing broader social aspirations, want their money not just to earn a financial return, but to make a positive difference. They care about broader sustainability goals that can only be achieved by coordinated behaviour change among actors in the predominantly economic systems that have generated current sustainability stresses. Institutional investors are among those actors. So institutional investors need to look more closely at their impact, both to achieve their financial goals and because their beneficiaries and wider society want it. And for both of those reasons, it's important to be clear about the legal framework within which investors can or even should seek to achieve positive sustainability impacts. And that's the purpose of a legal framework for impact, commissioned, as Iris was saying, by the UNEP Finance Initiative, the PRI and the Generation Foundation, and published by Freshfields in July. It addresses a vital issue for investors. Essentially, how far does the law require or permit investors to take deliberate steps to tackle sustainability challenges in discharging their duties? Something we've called in the report investing for sustainability impact, and I'll say a little bit more about that in a moment. The report provides the first ever international analysis of that question, and also a suite of policy options for policymakers who may be interested in facilitating this sort of investing. It's the outcome of a unique global collaboration between Freshfields and its Stronger Together firms across 11 jurisdictions, including all of the major investment hubs. Why did we cover 11 jurisdictions? Well, although the investment world is used to talking about investors' fiduciary duties, there is no single fiduciary duty, but actually different sorts of duty which vary between different jurisdictions and between different investor types. So answering our question needs to take account of that incredibly complex patchwork. So we needed to look at 11 jurisdictions, but then try to draw out the key themes, and that's what we've done in the report. And it's fair to say that the initial response has been very positive. So what am I going to do in the next few minutes? Well, I'm going to answer 3 questions. First, what is investing for sustainability impact? Second, is it legally required or permitted? And then third, what options are available to policymakers who want to facilitate it? But just before I dive in, this expression, investing for sustainability impact, is a bit of a mouthful, and the legal teams ended up abbreviating it to IFC, so that's what I'm going to do as well. So first of all, what is IFC? Well, IFC isn't a legally defined expression, and it's not used in the report as a term of legal art, and we are definitely not trying to add to the alphabet soup of the sustainability world, which is far too complicated as it is. Instead, we've used this idea of IFC as no more than a kind of conceptual net to catch a certain sort of activity. And that's broadly any activities that involve an investor intentionally attempting to influence the behavior of investee companies and other third parties like policymakers in ways that are accessible. That is important as well. So it's intentional change, but also change that is accessible and change that can help to achieve sustainability goals. What are sustainability goals for these purposes? Well, they are outcomes consistent with the social and environmental and economic and human rights goals suggested by various international instruments, and especially the Paris Agreement and the Sustainable Development Goals. An investor might pursue those impacts by using their investment powers, but they could also use any other levers, and importantly, and we'll come on to this in a minute, their stewardship activity, extremely important, and also policy engagement. So, as I've just said, sustainability impact goals are key to this idea of IFC. But what sort of goals are we really talking about? Well, the reality is that they could take many, many different forms, ranging, for example, from trying to get a business to change its processes to reduce its negative sustainability impact, so reducing polluted water emission levels, perhaps, or the launch of a new enterprise that is likely to have a positive sustainability impact, maybe in areas like developing battery technology. But it could range all the way through to higher quality enterprise sustainability disclosures to inform impact-orientated activity by investors and policymakers. Goals could also involve attempts to achieve better policy alignment with international sustainability commitments. Now, it's important to say investors are already beginning to engage in these sorts of activities. Obvious examples are the net zero asset owner and investment managers alliances, but they're actually at the moment still quite limited, but it has started. So from what I've just said, it should be clear that investors engaging in IFC are essentially concerned with 2 sorts of related sustainability impact. First, the impact on social and environmental sustainability of businesses, policymakers, and other third parties. But second, the influence or the impact that the investors can have on the sustainability impact of businesses, policymakers, and other third parties. And IFC has to involve looking at both of those 2 levels. And because of that, it is really quite different from what people normally are talking about when they talk about sustainable investing or ESG investing, because those sorts of investing are essentially focusing only on the first of those two sorts of impact. What they're really doing is simply investing in businesses that have positive sustainability footprints and underweighting their investment in companies that have negative sustainability impacts. There isn't really an intentional process of trying to achieve assessable change in behavior from those companies. It's essentially an investment filter. Now, by contrast, IFC involves both sorts of impact. It involves an investor recognizing that in order to achieve its objectives, it needs to pursue sustainability impact goals by influencing the sustainability impact of other third parties. What's often called impact investing is an example of that, but what we've got in mind with this concept of IFC is rather broader than what people have traditionally meant when they talk about impact investing. So hopefully that gives you a basic sense for what IFC is. And so on to my second question then, what does the law require or permit in terms of IFC? Well, to answer this, we had to start out by making a really, really important distinction between two different sorts of IFC, what we've called instrumental IFC, and then secondly, ultimate ends IFC. Now, at first, that distinction sounds a bit cryptic, but it's attracted a lot of attention and people are finding it's quite a helpful distinction. So it's worth pausing on it before we look at the legal rules. Now, essentially, these two expressions refer to two situations in which an investor might set specific impact goals to pursue. The first, instrumental IFC, is where achieving a sustainability impact goal can contribute to the client's attempt to achieve its financial objectives. So it's instrumental to the financial objective. Ultimate ends IFC, on the other hand, is where an investor is pursuing a sustainability impact goal for some other reason. In other words, the sustainability impact goal is pursued more as an end in itself, not so much because of its financial significance. Now, I do want just to emphasize at that point that we're not suggesting that the two couldn't be pursued together, or that ultimate ends IFC would necessarily be inconsistent with instrumental IFC. We're just looking at the sorts of motivations that investors might be influenced by in making decisions as to how they invest their money, and then how those motivations are related to legal duties, because the question of motivation is really important. What the motivating goal is really important when you're looking at legal duties. Just to give you an example of instrumental IFC, an example might be where deteriorating sustainability, taking the most obvious example as a result of climate change, is likely to damage the performance of whole economies, so threatening an investor's ability to achieve its financial goals. In other words, it's a systemic, or some would say systematic risk, a systemic sustainability risk. Now here, an investor might be engaging in instrumental IFC if it took steps to bring about changes in economic or policy behavior that are intended to reduce that risk. Now, obviously, because challenges of that sort are systemic, they need a system-wide response to deal with them, which is why we also pay a lot of attention in the report to the issue of collective or coordinated action. No single investor, in other words, is going to be able to solve climate change on its own. So this issue of collaboration is really, really important. Now, contrast that example with where an investor concludes that climate change is not going to have any effect whatsoever on its ability to achieve its financial goals, but still decides to try to influence investee behavior to try to facilitate facilitate solutions to climate change. That's an example of ultimate ends IFC. So With the benefit of that distinction, instrumental ultimate ends IFC firmly in mind, does the law require or permit IFC? And what we found is that to a significant extent it does, although given the diversity of jurisdictions and investor types, there are all sorts of nuances and variations. Taking instrumental IFC first of all, financial return is commonly the primary goal of institutional investors, obviously, so the situation is most clear where a sustainability risk bears on investors' duties to pursue financial goals. And here, where sustainability impact approaches can be effective in helping to achieve the investor's goals, the investor will likely be required to consider using them and to act accordingly. In other words, that's where an investor would be engaging in instrumental IFC, because pursuing sustainability impact goals of this sort is instrumental to realizing the investor's financial goals. Relevant factors for an investor in determining whether it should engage in instrumental IFC would include the direct and indirect costs and risks of acting, including the different impacts for different cohorts of beneficiaries in the fund. So short-term beneficiaries in a pension fund may have different interests in this from long-term beneficiaries in a pension fund. They also are going to need to take account of the relative likelihood that acting is actually going to help to address the sustainability factor so as to reduce the financial risk posed, or the relative likelihood of realizing financial opportunities. An investor might decide to act individually, but for the reasons I was mentioning just now, factors like those are likely to weigh in favor of a decision to foster or join collective investor action aligned with the same goal. That's instrumental IFC. Ultimate ends IFC. Cases where investors can pursue sustainability for their own sake in parallel with financial goals, those are more limited. But there are instances in just about all jurisdictions where investors can do it, subject usually to prioritizing financial goals. Now, the most obvious example is mutual funds that have been expressly set up with sustainability impact goals. But among the other categories of investors we looked at, insurers tend to have the greatest flexibility, because what it means for a company to be successful so for directors discharging their duties to the company isn't, by and large, isn't defined in purely financial terms. So the purpose of a company, the success of a company, generally, legally speaking, is not defined exclusively by financial measures. Now, we could have a big discussion about that, and maybe we will, but that's the situation. Collective action, I've already been hammering away at collective action a little bit, but I do just want to say some more about that. Because as well as focusing on investors' goals, the instrumental and ultimate ends goals, the importance of collaboration or cooperation is really a key theme in the report. As I've already noted, many sustainability challenges are essentially the result of behaviour by multiple actors across whole systems, and therefore they require collective action to resolve them. No single person is going to be able to solve the problem. Now, for various reasons, investors' attempts hitherto to comply with their legal duties have tended to be a rather individualistic exercise. They've tended to look at their own circumstances in isolation and not necessarily considered how they might enhance their prospects of achieving their financial goals by acting together with others. Recognizing that financial goals depend on collective efforts to achieve sustainability goals presents a fundamental challenge to that way of thinking. And by underscoring the potentially key role of collective action in discharging legal duties, the report, in my view at least, marks, I think, an important departure and raises some pretty significant questions from the point of view of prevailing market paradigms that emphasize competition. I've been talking about what the legal rules, if you like, say, what lawyers refer to as the black letter of the law. But in answering this question as to whether rules require or permit someone to do something, the circumstances in which the rule is being applied are equally important. And so the report, and again, this is somewhat unusual, I think, for a legal report. We have looked at the circumstances confronting investors when they apply these rules to try to assess what the rules may require or permit. So, for example, an IFC approach might in principle be attractive in a given case, but there could be too much uncertainty as to the outcome or the cost of acting to require or permit an investor to adopt it. In addition to those sorts of circumstances, there are a set of prevailing market features, such as prevailing portfolio theory and commonly used performance benchmarks, which may be having the effect of reducing attention to sustainability factors in investment practice, as a result, creating a risk of investors not properly discharging their duties if they're giving insufficient attention to those sorts of factors in their investment decisions. A further aspect of investors' circumstances that isn't addressed in detail in a legal framework for impact, but which is also highly relevant to this question, is the wider mental frameworks and social narratives by reference to which investors operate in deciding how to comply with their duties. And that's partly what my book of last year, which Iris mentioned, on the social license for financial markets is about. And we may be able to come back to that a little bit in the discussion. But essentially, the point is this: behavior, including, importantly, the way in which people comply with legal rules, is profoundly influenced by prevailing mental frameworks. And the frameworks commonly associated with finance and reflected in the assumptions behind much basic finance theory often follow the Homo economicus myth, that investors, their beneficiaries, and their investees are self-interested, rational utility maximizers. Now, that captures something of the truth, but is clearly inadequate as a complete navigational tool. And there's a need to look at the other available narratives, such as the recognition of a social license for financial markets, to help reset that balance and to recognize, as I was saying at the start, that investors want their money to do good as well as earning a good return. Work on investors' duties and sustainability has hitherto tended not to look at these circumstantial factors, as I was just saying, but a failure to take that sort of holistic approach can result in undue attention being given to the need to change legal duties to facilitate more sustainable investing, when really sometimes greater policy attention may be needed to impact infrastructure challenges such as those that I've just been describing. And so that takes me fairly neatly onto the third of my three questions. What are the policy options for policymakers wishing to facilitate IFC? Well, now, since the behavior produced by legal rules depends both on what the legal rules say and the circumstances in which they're applied, the report identifies options to tackle both of those two things. It doesn't just talk about how to rewrite the rules. It's important to emphasize that it doesn't attempt to cover wider interventions in primary economic activity or fiscal policy, such as carbon pricing, which can also fundamentally influence investment decisions. Now, clearly, those are a critical part of the equation, but they were just beyond the scope of the report. We'd still be writing it if we'd got into all of that. Now, taking those two things, legal duties first, then circumstances. On legal duties, the sort of options we've highlighted, I don't have time to go into them all in detail, but they would include changing investors' legal duties and discretions, but also importantly, how they're understood. And changing them, the ways they're understood in ways that facilitate IFC. So in the case of instrumental IFC, it follows from what I have already been saying that probably guidance on the importance of investors pursuing sustainability impacts and on doing so collectively could be sufficient within the existing legal framework. But it would be possible, if you wanted to go further than that, to do things like introducing a legal presumption that investors should engage collectively in pursuing sustainability impacts. So that would be an example of a black letter change to the law, because that presumption doesn't exist at the moment. Attempts to facilitate ultimate ends IFC, again, it follows from what I've just been saying that this would probably require more of a change in the law. So the sort of example, the sort of thing that we've suggested is possibly allowing the pursuit of sustainability impact goals subject to prioritizing financial return goals. Switching over to the circumstances in which the rules are applied, we outline policy options in three broad areas. First, building the enabling framework, enabling environment for IFC, for example, by ensuring the availability of decision-useful corporate sustainability data. Second, promoting in-depth research on whether market features such as prevailing portfolio theory may lead investors to underweight sustainability factors in their decisions and steps to address that if so. And then third, strengthening market discipline, for example, through product labeling and governance rules for sustainability branded products and ensuring that investors' sustainability preferences are properly reflected in the investment process. And although we don't go into it in the report, it follows from what I said a moment ago about the behavioural force of mental frameworks and social narratives, that options for change would also need to involve looking at those. So there you have it. Investing for sustainability impact, what it is, whether the law requires or permits it, and policy options. Thank you very much. Back to you, Iris.
Thank you, David. I've always thought that the law may not be perfect in terms of achieving some of our normative ambitions in changing social environmental circumstances, but surely the panel and the Q&A will probably pick this up in greater detail. So now we move on to our panel of commentators. We have an excellent panel, starting with Professor Emma Borg, who is Professor of Philosophy at University of Reading. Emma has written extensively on business ethics, and is also an expert on exploring social license in relation to business-society relations. So Emma will speak first. Following that, David Trenchard, who is advisory board member at the Institute of Directors Centre for Corporate Governance, will speak. David was formerly vice chairman of one of Europe's best-known activist management companies, and he is now still an expert as well as consultant advising investment companies on corporate governance, on stewardship and engagement matters. He's also holding non-executive directorships. I met David as a co-member of the advisory board at the Institute of Directors Centre for Corporate Governance, and David will be addressing us on issues of active engagement and investor stewardship. Following which, Professor Lorraine Talbot will speak. Lorraine is Professor of Corporate Law at the University of Birmingham. Being the only lawyer on the panel, I have curated this panel in order to reflect interdisciplinary interest. Lorraine has written extensively on company law, corporate governance, many critical commentaries in the area of corporate governance and investor stewardship, and I very much look forward to your contribution. So without further ado, can I hand over to Emma, please?
Excellent. Thank you very much, Iris. Thank you for putting on this great event and for inviting me to be here. It's been really interesting so far. I'm going to play up today. Sorry. So as Iris mentioned there, I'm a philosopher, so I'm going to come at things from the philosophy side of things, but I take it that my comments are going to support the general conclusions that David's report is reaching. And I'm going to talk about the conclusions of the report in connection to an idea called social license that David has already mentioned and that he's published on previously. Okay, next slide, thanks. So we're interested in the question of investing for sustainable impact. I'm delighted to hear that we should be pronouncing it IFC. That's very helpful. Thank you. And as noted in the report, we can identify different kinds of arguments that give rise to a case for IFC. So the most obvious argument that we might give here is a kind of business case, where we're going to say that an investor should engage in IFC just in case it's going to promote financial returns, or if we think that the threats that are being posed by climate change are such that they're going to level an existential risk on returns. So in either of these kinds of cases, then we get a business case for IFC. But as is noted in the report, that kind of business case is only ever going to give rise to what David calls an instrumental IFC, where we pursue sustainability impact, but just because it promotes some other end that we want, namely financial return. But I think it's important to note that that kind of IFC looks sort of optional or contingent, okay? If we don't think that the sustainable investment is going to make a greater return, then there's no requirement on us to be engaging in it. So what I'd like to investigate is whether there's an argument we can give for a kind of non-optional or ultimate ends IFC coming from the kinds of considerations about the nature of investment. So could we demand that investors consider sustainability independently of the kind of financial return that the activity is going to generate? So that's the question in my remarks that I want to address. So I think we can identify a couple of arguments that might suggest we can provide that kind of requirement. Maybe we should have a kind of general argument where we might just think as stewards of the common good, it's vital that, everybody, investors, policymakers and regulators all steer the world onto a kind of more sustainable path. And those are the words of Inge Anderson in the foreword to the report. I think that kind of argument is probably right, but I'm wondering if there's a more specific argument that we could also offer. This general argument is going to apply to everybody, I take it, that, we should all be aiming to put our activities on a more sustainable footing. But what I'd like to investigate is whether there's a more specific argument that we could level just at those who are involved in investment. So the argument I'm interested in is one that claims that anybody who is seeking to make a profit from the structures of private sector organizations are in fact required to conduct their actions in line with what I'll call a social purpose alongside a justified profitability purpose. Okay, next slide, thanks. So can we think of businesses as having a kind of social purpose? Well, again, I think there are different arguments we could give here. I'm going to suggest one to you. I think it's one that David has suggested in other places he's not that fond of, but I'll run it anyway, which is the idea that a demand for a social purpose emerges out of the nature of a social contract. Okay, if we could see the rest of the slide, thank you. So I'm sure that the idea of a social contract is massively familiar to everybody in the room already, but just to make sure we're on the same page, we could progress the slide, thank you. The social contract is an idea that was developed by Enlightenment thinkers, people like Hobbes and Rousseau, and it refers to the idea of a kind of tacit agreement between individuals and the state. When it was originally formulated, there was talk of organizations as well, but the focus was primarily on this relationship between individuals on the one side and the state on the other. And the idea is that individuals give up some kind of freedoms that they might enjoy in a sort of state of nature in order to reap the greater benefits of living within social order. So, just to think about a quick example, I might, in a state of nature, really enjoy driving my car at whatever speed I want to drive at. But I recognize that I don't really want to live in a world where people can drive at 80 miles an hour past my own front door. So I give up the freedom to drive at whatever speed I like in order to live in a society where people can't just drive, ignoring any speed limits. So that's the kind of idea behind a social contract, the idea of giving up some freedoms to reap the rewards of social order. And it seems clear that that kind of thinking extends directly to the idea of private sector organizations, because a business model only makes any kind of sense within the structures of a society. And furthermore, the benefits to business of social order and a well-functioning state are absolutely transparent. So businesses benefit from a range of things that are transparently social goods that society delivers up to business to allow it to function and to thrive. So businesses require things like a good transport system, a well-educated workforce, legal protections, not least the kind of limited liability that gets issued to corporations. All of those things are social goods that society allows business to make use of. And furthermore, during the pandemic, and indeed before that, during the financial crisis, the state stepped in to save private sector organisations through the provision of support funds, loans, and other schemes. Okay, next slide, thank you. So we can see then that this kind of highly integrated reciprocal relationship, we could advance the slide, thank you, is one that's going to underpin a kind of constraint of a social purpose for organizations, because business is making use of these kinds of social goods, it creates a demand on businesses that they in turn contribute appropriate social value. That is to say, they must be of benefits to the society that they're serving. They have to have a social purpose. So I think the social contract way of looking at things allows us to recognize that societies have the right to demand firms have a social purpose, that is, that they create social value. And investment firms and individual investors as members of this private sector structures are not free from that requirement. And one more point. And in fact, we might think that it's actually a stronger case than that. It's not just that investment firms are subject to the same kind of constraints as others. We might think that actually they're more susceptible to these constraints to create social value, because in some ways they depend more significantly on these social structures. So this is a point that David's made in the book we've already mentioned. The raw materials of the investment services are paradigm social constructs. So there are things like money and shares and debt, things that can't exist without society. So we might think that investment firms are even more subject to the requirement that they create social value through their activities. Okay, next slide. Thank you. Okay, and these are the last points I want to make. I want to suggest that the social purpose is what the firm itself needs to develop and show how it's delivering on. And if it creates an appropriate social purpose and shows how it's delivering on it successfully, then society will deliver up a kind of social license to that organization. We could advance the slide, thank you. That is to say, that organization is going to acquire the broad agreement of society for the conducting of its operations. Now, this notion of the social license is one that's come out of the mining and extraction industries. Those two papers that I reference are ones that come from that background. But more recently, the idea of a social license has been extended beyond those traditional sectors to consider other areas. So David's book is a paradigm example here. And here's John Kay again, raising this wider construction of the social license. Kay writes, the social license to operate is not, as sometimes suggested, a fee for the privilege of limited liability, but rather an understanding which arises from the knowledge that all property rights in a complex economy are social constructions. And the regulation of such social construction is necessary to legitimate the private exercise of authority. So I want to agree with Kay here and suggest that to achieve legitimacy, investment firms must meet the terms of their social license, and that's going to include delivering on sustainability issues. Okay, final slide, thank you. So just to conclude quickly then, I think what I've tried to suggest to you is that society has the right to demand a kind of non-optional or ultimate ends IFSI. Next point. And that's because ignoring sustainability issues at a time of climate crisis represents, I think, a breach in the tacit contract which exists between society and investment organizations. Thank you. Next point. So I think to achieve their social license to operate, an investment firm must demonstrate how they're going to contribute to the social good, and that is going to require them to show how they're taking a stand on IFC. Okay, and just the final point I wanted to make, I wanted to finish with raising a question for David or for my fellow panelists, which is, if you take this kind of social license perspective, I think it becomes natural to think of the first point of kind of intervention or recognition or reporting as being the institution. So we would think about regulating or requiring reporting from organizations before thinking about regulating products in terms of how they contribute to IFC. And I just wonder whether that seems the right kind of approach to David, or whether he thinks a more bottom-up approach, starting with product, is a better way to go. Excellent. Thank you.
Thank you. Thank you very much, Emma, for these very enlightening thoughts. And I do agree with you that regulatory policy may have a huge part to play. Can I now turn to David Trenchard for your contribution on what you see the activist or active investor to be doing at the moment? David, please.
Yeah, well, thank you again. Thank you very much for inviting me. This is a fascinating conversation. I have to confess, I'm suffering from a huge degree of imposter syndrome right now, because I'm not actually an impact investor. I do, I suppose, work with a lot of asset managers and activist funds, and so I guess I have a pretty close view of how some of these things are actually being executed in practice. But I thought I'd cheat, first of all, by asking one of my friends who's very much involved in this world, you know, how they would define impact investing, because I sense that there is a huge spread of different definitions of what impact investing means, what ESG investing means. I spoke to a friend who had previously been head of corporate governance at one of the larger European insurance companies, and a few years ago was appointed head of impact investing. And I asked her what that actually means. What does the job actually entail now? And I mean, this is a pretty forward-thinking, responsibly investing institution, which was looking at things both as an asset manager with clients, but also as an insurance company with its own concerns and obligations. And their starting point had been that they were looking at avoiding risk. How can they engage with companies? How can they disinvest in things that were going to expose either their clients or their business to future risk? But they very quickly saw the opportunity to focus on solutions, and they established a dedicated fund, which this person now runs. Was initially seeded 100% by the parent, because this was seen to be quite out there. But it's now a very successful fund with external clients. And their definition, or her definition to me just a couple of weeks ago, was: we look at direct or indirect investments in businesses, organizations, and projects that meet the existing risk and return requirements that we have, but also have the intent to create a measurable social or environmental impact. But then we take that further, because we want to emphasize and capitalize on the positive aspects of investment, as compared with what we would see as pure ESG investing, which we still see as more of a desire to manage and minimize risk. And they've done a huge amount of due diligence. They've looked into areas where impact investing and financial returns go, in their minds, in lockstep. Their starting point was that if we focus too much just on impact, we won't attract external capital. So there's a commercial imperative to make this a product that we can sell. And therefore, there's probably a sweet spot. They very quickly found that was quite a large sweet spot. There were too many opportunities that they had to turn away in areas like education, in healthcare, and sustainable food and agriculture, in renewable energy. And more importantly, they said, we started off by running this very much as a private equity fund, investing in private small projects. We found that we were seeing themes, we were seeing developments that actually really informed our public markets activities, and therefore what we were finding from our private equity experimental investments in the early days in impact projects were actually giving us huge competitive advantages and creating what the fund managers would call alpha in their traditional portfolios. So it was a hugely successful initially experiment and now business line. And then I spoke to another very good friend, actually a fellow colleague of the IOD's Centre for Corporate Governance, who's very involved and works closely with Federated Hermes, which some of you may know as formerly the BT Pension Fund. It's now, I think, one of the most sustainability and governance focused investors and advisors. They have one fund which is called the Federated Hermes Impact Opportunities Fund, which by sheer coincidence, I received a marketing document from a week or so ago. Funds about £500 million of assets, so it's quite large. Its performance last year was it generated a return for its holders of 29.11%, and it has a global benchmark, so the MSCI Global Index was up 16%. So that's a tremendous performance. But that's not what they're advertising. And the front page is all about the fact that they have an ability, a technology, if you like, to measure what they see as their real impact. And that they believe that as a direct result of the impact of this fund's activities, they saved or they avoided 48.4 million metric tons of CO2, for example. 97.1 million megawatt hours of clean energy was generated. 1.29 billion cubic meters of water was saved. 220 million patients were treated. I mean, those are the figures that they're advertising, not the performance. The fact is, the performance is very good. Now, I realize 1 year isn't necessarily representative of the long-term theme, but it does show that actually the commercial imperative and the societal imperative can be very complementary. The Federated Hermes investment process revolves around 9 impact themes and pretty evenly split: water, food security, health and well-being, education, financial inclusion, future mobility, what they call impact enablers, energy transition, and the circular economy. So it's pretty sophisticated, and I would argue that Federated Hermes is probably at the more fully evolved end of the impact investing spectrum. And the reality is that spectrum ranges from a bit of ESG engagement to those dedicated impact funds with very measurable outcomes. And quite a lot of the investment institutions that I work with will move up and down that spectrum over time, and it'll depend to some extent on their client demands, on perceived performance impact, and importantly, the impact on asset gathering. But I think the conspicuous success of active engagement means that the integration of ESG thinking in shareholder activism campaigns is only going to continue to grow, and that's music to my ears. I think investors are increasingly seeing corporate attention to ESG criteria as being linked with business resilience, with competitive strength, and financial performance. And it's pretty clear now that the world's biggest investors have fairly publicly nailed their colours to the mast of the potential of ESG to unlock shareholder value and to make companies and markets more sustainable. So you only have to read the marketing materials of any of the big investment houses, or I think perhaps even more significantly, to look at the enormous inflows of money into the funds with explicit ESG mandates or sustainability mandates to see the effect of this. So whether it's cause or effect, the inflows have generated some pretty significant outperformance of ESG-themed funds. So at least for now, there's a fairly clear virtuous circle that's developed. But what I was asked to talk about was really what this, what's the involvement of shareholder activists and how does that link into this whole discussion? And my view on this is that this is providing many more opportunities for company-specific engagement as well. More mandated ESG disclosures on companies means that more light's being shone on underperforming companies. There's therefore huge support for activists who are engaging with the more traditional, what we in the industry call long-only investors, who are maybe cynically, but wishing to burnish their own ESG credentials. So you tend to find that an activist investor might deploy ESG arguments in its engagement for a variety of reasons. They might genuinely believe that greater attentiveness to environmental and social factors will increase a company's valuation by de-risking the business, by making it more sustainable for the long term and unlocking perhaps new opportunities. But it might also be that the activists just understand that many of the large institutional funds will find it hard not to support an ESG-themed campaign, if only for PR reasons. So it's far easier to gain traction amongst fellow shareholders and stakeholders, even if you have a very small investment. And there have been a couple of recent examples of that. Quite close to home, there's a small activist fund based in London, which has been using this sort of leverage very effectively, a company called Bluebell Partners, which I understand owned 1 share of Solvay, which is a Belgian chemicals company, which they were accusing of, and I think fairly accusing of fairly egregiously polluting the Mediterranean. With their one share, they ran a very effective campaign. They've cooperated with a lot of other shareholders and NGOs, and that campaign is not over. But I think their one share is going to have created quite a lot of noise and activity at Solvay. And the same company, Bluebell, just more recently has called for Glencore to divest its thermal coal and to separate its carbonized and decarbonized assets. I mean, this is a very small investor with a minuscule ownership, but is leveraging the support that the traditional investors are now feeling almost obliged from their own clients' requirements to support. And I suppose the best example, and I'll try to be quick because I realise we're under some time constraints, but probably the best example was earlier this year in the US, the situation with engine number one and ExxonMobil, which is a fairly high-profile activism campaign. The story, as I understand it, Chris James, who I do know a little bit, who was one of the founders of engine number one, was having dinner with his kids a year or so ago, and they were asking him how he squared his environmentalism beliefs with investing in energy companies, which is a pretty good question, which I'm sure many of us in the investment world with children will have faced as well. And his answer, he realized, wasn't a very good one, so he decided to do something about it and set up engine number one, which in almost exactly a year ago bought a tiny stake in ExxonMobil. I think it was $40 million US, which is 0.02% of the company. But they ran a pretty high-profile campaign which highlighted that the company had been underperforming its peers for any period of time you looked at, 1, 3, 5, 10 years. It had done a lot worse than BP, Chevron, Shell, Total, etc. And more importantly, the board, and particularly the previous management and the management under Lee Raymond, had been pretty explicit and prominent climate change deniers, and they'd taken the view that the world needs us. If you don't like us, sell your shares, but we're going to carry on drilling and developing oil fields. They published an open letter. They published a very detailed website with a lot of their analysis and thinking on. They had 4 primary claims. They wanted to refresh the board. They wanted, importantly, to impose greater long-term capital allocation discipline. But I think the thing that got the most attention and the most support was they were calling for the implementation of a strategic plan for sustainable value creation. And they were also calling for an overhaul of management compensation. This all seemed to be pretty obviously good, but the company was believed to spend over $100 million in fighting this engagement, fighting this campaign, which was $100 million of shareholders' money, which arguably was not a good use of shareholders' funds, because there was clearly huge support for the arguments that engine number one was making. The media clearly was very supportive. An activism fight is always good press, so there's always good coverage, but this was very well supported by the press. There was a lot of academic support. I mean, Robert Eccles and Colin Mayer, who some of you may know from Side Business School, published a pretty thoughtful piece in the Harvard Business Review, which the one quote I scribbled down from this was, Exxon's poor capital allocation stems from its decades of climate change denial. That came out at about the same time as the engine number one campaign started. But then more importantly, some of the biggest investors on the planet came out saying, we have to support this. Most publicly, I think, the California State Teachers Retirement System, which is a $300 billion US pension fund. I think it's the second largest pension fund in the world, or second largest US pension fund, certainly. They very publicly supported it. One of their portfolio managers, Aisha Masandi, was quoted in the FT saying, all of our traditional engagement tools have failed at Exxon. What we need here is a whole new strategy, a whole new culture, a whole new way of thinking inside that boardroom. We want this company to be more resilient and strategic because the low carbon transition is coming. The world is changing and Exxon needs to change with it. So you have a $300 billion pension fund saying that. Suddenly, that no longer is it 0.02% of the company talking. This is one of the biggest investors in the world. The Church of England Pension Fund, which has been a real thought leader in a lot of areas around sustainability, was also very public in its support. And many other big pension funds, CalPERS, many of the big passive funds and the index investors were hugely supportive of this. And the net result of that was that despite Exxon's fairly brutal pushback on this, engine number one resulted in, the company appointed 2 replaced 2 independent board members, and the engine number 1 won 3 additional seats on the board. So it was a wholesale change of the board of one of the largest companies in the world, one of the biggest polluters in the world, which is now undergoing a pretty fundamental philosophical reassessment of its raison d'etre. So I think that was a really interesting kind of case study of how an activist, with its forensic approach, with its huge incentivization to do stuff like this, can work with some of the biggest investors in the world and achieve what I think is, for most stakeholders, a very positive outcome. So my conclusion would be there's demonstrably mounting pressures from investors on public companies to enhance their disclosures, to enhance their performance on all aspects of their commitments to environmental and sustainability issues, social issues, labor issues, and the many other stakeholders to whom boards and managements are properly beholden. But I think asset owners are increasingly, the asset owners are holding their asset management firms to account, and the asset management firms are increasingly required to hold boards to account, and boards are holding managements to account, and that's the key to this success. So the role of a focused, highly resourced, highly incentivized activist fund manager has never been more aligned with the current zeitgeist. And so I think this is a theme we're going to hear a lot more about. So I'll stop there. I can talk for hours about specific campaigns if people want to, but I think probably there are more interesting subjects to discuss here.
Thank you very much, David. I think very encouraging to hear, and would be really happy to catch up with more stories with you, probably over the Q&A if people would like to raise some questions on that. Shall I now move to Lorraine to give us your point of view from corporate governance and investor stewardship? Over to you, Lorraine.
Thanks, Iris, and thank you so much for inviting me. I'm going to try and share my slides. Okay, so I've been listening to everyone, and I'm suddenly really happy about life, and much happier than I was when I was writing my own thing, because I'm going to be a little bit of a Cassandra, I'm afraid, from all the positivity that we have heard thus far, because I have to say, I think that there is a problem with shareholder engagement in sustainability agendas. And I think the problem is that they concretize the already substantial barriers to corporate solutions to sustainability. I don't think corporations can deliver sustainability because corporate decision-making is dominated by the demands for profitability. Management benefits, it secures its position and enhances its performance-related pay, but shareholders are even more bound to that profitability, and shares themselves are nothing more than claims to profitability or governance rights to secure those claims. So when you hear the big headline figures of like Mark Carney, that he's heading up a global Glasgow Financial Alliance, that covers a collective $130 trillion, and that by 2015 they'll have contributed 70% of the fundings to get to net zero emissions by 2050. I just think it's not realistic, that the investment needed for zero emissions are too high. Morgan Stanley, who David knows very well, reckons that an additional 50 trillion will be needed on top of what's already agreed to meet the Paris Agreement. And the power to do this resides with people that are who have too weak incentives to do so. So why is this? Well, I want to make 4 points to back up this prediction. First, that the significant shareholders who push for profit maximization are both more in control of corporations and less embedded in the companies in which they own shares. That shareholders are more empowered in law and governance than they ever have been. That states are more bound to the imperative of markets and corporate capitalism than they ever have been, and that profit maximizing is not compatible with the investment in green innovation required to meet sustainability goals. So who owns what? Well, just to take us back in history just a little bit to some perhaps political philosophers that took issue, first of all, with Burley's thesis that in large corporations, ownership was separated from control. They instead argued, and I'm looking at people like Hilferding here, that increased shareholding throughout the population would actually create a centralization of control, with the wealthiest investors requiring a smaller proportion of shares in major corporations in order to exercise control, albeit through a professional board of directors. So in this way, we're going to see a smaller group of financiers who are controlling what happens in corporations, including, of course, anything relating to sustainability. So as we are aware of, the rest of the world own the majority of the equities in the FTSE 100 company, and the rest of the world are mainly American unit trusts and other institutional investors. And the problem with that is that these shareholders are more detached from what happens with these companies, and they engage in either very little monitoring, or what engagement they have is extremely detrimental to any sustainability issues. So when we look at passive shareholders, as we know, they tend to be spread across the FTSE 100, or we have the problem of common ownership, where asset managers like BlackRock, State Street, Vanguard have been accused of concentrating their ownership in particular sectors, resulting in price fixing, low research and development because competition is discouraged, and low research and development means less investment in the kind of sustainability outcomes that is required to meet the challenges of climate change today. Connectedly, that reduced investment is related to lower productivity, which has an impact on economic equality. When it comes to active funds, we can see in the UK at least a much greater focus on buyouts, private equity buyouts that impose the kind of restraints on the companies that they take over, which precludes more sustainable activities, indebtedness that force a focus on shareholder value above anything else. So if we just look at something like the activities in BHS and Philip Green and BHS, that kind of buyout, we can see that the law actually backs people who are both directors and shareholders representing their own interest in a fairly circular way, so that we have no input that can be more outward looking and more community orientated as well. In terms of the greater control that shareholders have, David was talking earlier about the kind of scenarios where investors may be required to take a more sustainable decision if that has no impact on returns, or if at least there's some kind of equal approach to that. And that is really where we are in company law in terms of the much discussed section 172, that it's a section that is orientated around the promoting the interests of the company and the best interests of members, and looking at environmental or sustainability issues if there's a win-win scenario. But whether or not one could say that a decision taken that doesn't tick the sustainability box and could tick the sustainability box would itself be a breach is another matter, and that doesn't seem to be the situation as it stands in law at the minute. Since the global financial crisis, corporate governance has shifted its concern with management delivery of shareholder value alone to the involvement of shareholders in monitoring corporate decision making. And this concern, as we know, is manifest in numerous initiatives from stay on pay to shareholder stewardship. But this shift in shareholder-based governance has entailed both a reaffirmation of shareholder entitlement to control and a reaffirmation of their entitlements to the fruits of corporate activities resulting from their governance. And as such, this form of governance undermines the sustainability required from corporations today. We know that there are socially responsible investment funds, and much is discussed around this. The famous £10 trillion of managed funds using ESG criteria, perhaps slightly less than that. We know that the UN is involved in setting up principles, and there are all sorts of principles which can be taken on by investors. But really, as David noted earlier, these are no more than a very rough filter in terms of investment. So invest in anything as long as they don't primarily use fossil fuels. That's the perspective of Parnassus. Jupiter assets, no nuclear power, tobacco, but most of their investment is in FTSE 100, so it doesn't really make an awful lot of difference. When we're looking at the corporate culture of these SRA type funds, we can see that they're extremely embedded in corporate orientation and corporate culture in terms of having an index, in terms of having corporate governance type rough principles, in terms of having performance indicators, which have to be something that is identifiable and clear. So environmental impacts give that kind of clarity. But always these things are backed up by high profit. The justification is that you make more money by being a good investor, so make more money. It's a no-brainer. It's a win-win situation. But when you drill down on this just a little bit, you can see that that whilst if you are a very high polluting company, you're not going to do very well. Yes, a light can shine on, but be shone by investors on those companies, and they're not going to do so well. But only a little bit, a homeopathic quantity of sustainable activities are needed to elevate that company and increase their profits. Nothing that is substantial can be done within a corporate setting. In terms of sorry, I'm clicking on the wrong thing. In terms of states themselves, they too are bound to the imperative of markets and corporate capitalism. So we know in the recent COP26 that the £100 billion promised after the last Paris Accord has not been met, and in any case, around 80% of those are loans anyway. Morgan Stanley, noted earlier, says that this is insufficient in any case, putting the figure at 50 trillion. And states are much more likely to subsidize fossil fuels than they are to invest in sustainable energies of any kind. Profit maximizing is just not compatible with the kind of investment that would be required to engage in green innovation and the kind of green innovation that would be required to meet sustainable goals. So there is much more investment in the increased production of fossil fuel than there is anything like the investment in sustainable energy products. Investors generally prefer non-capital intensive corporations, not those that are going to invest a lot in innovations and capital intensive activities. They much prefer financial organizations that they can move in and out of very, very quickly. The largest corporations are tending now to hold on to capital and not to invest capital, because investing capital keeps with it a risk, holds a risk. They will hold on to capital, they will use it to buy back shares, but there's very little in the way of substantial investment in innovations that will actually make a difference. The reason being that it doesn't generate enough return on that capital. It's much easier and quicker to meet shareholder value by engaging in financial activities and restructuring that capital rather than investing in tangible investments. Smaller companies don't have the kind of capital required to make the investment that they need to. In fact, for many small companies, they're hanging on by their fingertips and don't have the flexibility to engage in the kind of investment that is required. So Cassandra-like, it does seem like it is all rather bleak when it comes to being able to see corporations and investors as being at the forefront or being any significant part of enhancing in sustainable activities. We talked about, or Emma talked about earlier, about the social contracts and how corporations rely on a whole society in order to allow it to function. And this in itself should give enough pressure to make corporations and investors operate in a socially responsible manner. But I think what we in fact see is that corporations are not going to be part of the huge infrastructure changes that society is going to have to do in order to meet the challenges of a sustainable world. We are going to have to see fossil fuels massively reduced. That means retraining for thousands, millions of people. It means a new infrastructure that corporations are not going to fund. We cannot rely on corporations for that. We can make quite ambitious demands of private institutions, both in terms of the kind of regulations that we will require them to be under and the kind of tax that we require them to pay. So I think the situation is that our states, our individual governments can do quite a lot if they have the will to do so. And the reason that there is some optimism to be found here is that actually a very small percentage of gross national product could be utilised to engage in the kind of infrastructure changes that we need. And the good news is that they rely on our vote, and that is where our power resides, not, I think, in taking too much from the small optimistic stories that we can hear from sustainable investors. Thank you.
Thank you, Lorraine. Very thought-provoking, and certainly, I think this panel also raises issues regarding whether looking into corporate law, corporate governance, and investor stewardship forms a large part of the policy mosaic to deal with some of these global sustainable challenges, and what part really should the law play in these areas, particularly of what we call private law, the private law of corporations and their relationships with shareholders. But also bearing in mind the social footprint of some of these largest corporations, as well as investors. So many difficult questions. Question for David Rouch. Accepting in principle the benefits of collaboration between investors, should we also promote coordinated action between investors and stakeholders? Well, and I think that is quite sensible, because stakeholders may have a strong orientation towards IFC objectives. I thought perhaps both Davids could give this question some insight. Shall I call on David Rouch first?
Yeah, so the challenges are systemic and therefore require coordination right across the system. of anyone who has an influence on the outcome. And therefore, when you're looking at collaboration, I don't think we are just looking at collaboration between shareholders. I think in considering how what their legal duties might require or permit them to do, they need to look at the activities of all potential stakeholders to see whether, taken together, actually it leads the investor towards a particular course of action. Now, that might not be active steps to collaborate with a non-shareholder third party, but it might be. So to give you an example, we see cases of investors working with the academic community in order to generate research that provides them with the sort of platform they need to engage with policymakers and companies. So that's a form of collaboration. So I don't think it is just a collective shareholder action. I think it's much broader. But I think David's excellent examples, of which I think we touch on one of those, the engine number one. I mean, clearly, those are very interesting areas of collective action and very, very powerful in terms of the results.
I mean, if I can just jump in, because I think the engine number one example is a good example, but I think one of the interesting things about the mandate that most activist investors have is they have a mandate to dig very deep and to throw an awful lot of resources at a campaign. So, Elliott Management in the UK, or in it's a big US hedge fund, but they have a very big presence in Europe. They would typically spend, I don't know, $5 million on one engagement with a company, and for that, they would expect to get a very, very deep understanding of who all the stakeholders in a situation are, and how can they work with those stakeholders to help build the consensus to bring about the change that they're after. Because shareholders are only one stakeholder. They can be an important stakeholder, but in some industries and industries where I've been involved in activism campaigns, the shareholders are probably amongst the less important. If you were, I was very involved in a couple of engagements with some large banks. Ultimately, the most important stakeholder in the banking industry, certainly through the financial crisis, was the regulator. It was the Bank of England, or it was the central banks of different countries, and the regulator that was that the regulator was going to agree with your thesis and your proposals before you had any chance of getting any traction with the board of that bank, because clearly the board is going to listen to its regulator. If you can then get support from employees, from the financial press, from government, from other policy advisors, etc., then that all becomes very powerful. And cynically, what we would think about is, who's the board going to listen to most closely, and who's most likely to impact their behavior? Is it fellow shareholders, or is it other stakeholders? And we would very deliberately target those other stakeholders and work very closely with them. We would engage them professionally if that was an option. We certainly work with a lot of academics to give credibility to some of the thesis, but also to broaden the tentacles of kind of where that engagement could filter into. So I think the answer is, from a purely practical perspective, a successful engagement is only going to be successful if you do utilize the many different stakeholder avenues that you can use.
Thank you, David. Just wondering whether Emma or Lorraine might want to jump in on this. Do you have any comments, either of you or both?
So I guess maybe not directly on this, but I think maybe just reflecting on the other comments that the whole panel have made, and the question of, who's going to be pulling the levers here, who's going to be instigating the change. So I was really taken by a lot of what Lorraine had to say about why we should not be too optimistic here. I do think that there are concerns, and I guess that I would favour, I think that's maybe one way in which I might differ from some of the other panelists. I think maybe David wouldn't be so much in agreement here, but I do think there's a big role for the state in this kind of area, that we do need to be creating change at that level, because these kinds of cases are a clear of what, in philosophy we call moral hazard, because for all the reasons Lorraine gave, companies that don't want to engage in IFC are going to be reaping the benefits where the rest of society is going to be carrying the costs of climate change. And I think in any of those cases, we're going to need a range of levers. So we may well need the kind of collaborative work that the Davids were talking about there, where we pay more attention to the needs of stakeholders or to what those stakeholders want. But I also think we're going to need to pull some pretty serious kind of regulatory levers here to instigate the changes.
If I can also back that up as well. We do need huge regulation over the kind of things that investors do and don't do. And I think that investors' engagement is actually problematic per se. I think if we had less investor engagement, we would be doing a lot better, because I don't think that, I think the investors are the least able and least equipped of all the groups involved in corporate activity to make a positive impact on sustainability. I think communities in which those businesses work are an important stakeholder. I think employees that work for those corporations are important stakeholders. They're actually embedded in it. But investors are so physically, morally, and in terms of incentives, divorced from an interest in any real change to issues relating to sustainability, that they should be the least of the voices that we hear, and perhaps we shouldn't hear them at all. If investors want to take a cut of corporate profits, that's fine. But I think that cut should come with zero voice and zero control over what corporations do.
It won't surprise you to know that I fundamentally, categorically disagree with almost everything that Lorraine just said. I recognise many of the things you said in your presentation. I agree with and can accept. But I think unless you believe that capitalism doesn't work as a structure for society, then I think you have to recognise that ownership has responsibilities, and responsible owners are exercising those responsibilities, and I think increasingly well. And I think it's happening. It may be a very cynical way to look at it, but it's happening because it's commercially the right thing for these companies to do. They may not even believe it themselves, but a very good friend of mine is chairman of a quite a large private equity firm. He's the most red-blooded, kind of unreconstructed, old-school capitalist you will ever meet. 5 years ago, he wouldn't have had a thought for anything other than maximizing the returns to his investors, because that's how he made the most money to fly his private planes around the world. Today, he is driving probably one of the most impressive programs within the private equity world. And he's doing that because he said, that's my business imperative. I won't have a business if I don't have a proper answer to my LPs, my limited partners, the people who invest their money with us, because they need me, they want me to manage money on a way that is sustainable and that will deliver long-term performance rather than short-term gains. And so if I don't have a properly thought through, demonstrably successful ESG engagement with all of my investee companies, I will lose those assets, and that's the thing that's driving his business decision. So he may be doing it for all the wrong reasons, but the outcome is still the same, which is that he is forcing the companies that they're investing in to think very differently about the future, about sustainability, about all sorts of implications of social engagement. And I think that's a very healthy outcome. So I think that the markets are actually doing what they're supposed to do here. And that shareholders are holding boards to account. I completely refute the suggestion that shareholders shouldn't have a say. I mean, ultimately, shareholders must hold boards to account, but boards to account for what? For their engagement with stakeholders and for this whole exercise of sustainability and long-term performance. And I think that's increasingly what people are looking for. So I think the idea that fund managers are measured on monthly or quarterly performance, and that's all that matters, is a very, very historic attitude. And I don't think any fund manager would keep their client base very long if they behaved that way, is point one. I think some of the analysis that you showed of sort of ownership of stock markets, etc., is a little flawed. I mean, 54% of the UK market being owned by the rest of the world, that's probably true. But if your pension fund is managed by Fidelity, you're part of the rest of the world. The reality is, we all have a stake in the stock market, whether we own it directly or not. We're all funds or have money in some sort of saving schemes. We're all investors in that. I don't know about you, but I certainly invest in funds which I know are behaving in a way that I feel comfortable with, and I feel comfortable talking to my children about. And I think most investors, not me, many investors are increasingly feeling that way.
Right. Thank you, David. And I'm sure there is a very animated debate going on in terms of how we see shareholder stewardship, shareholder rights, as well as how that all contributes, to the larger purpose. And I think one comment that has been raised on the Q&A probably threads a midway between Lorraine's concerns and David's concerns, and that is whether or not leaving it largely to private interests, to shareholder stewardship, to activist shareholders to dictate, I think, the priorities and the agenda for ESG development and corporate behavior, whether that should be the way forward. And that reliance on private interests, I think, probably is what Lorraine is talking about in terms of being worried that the state would therefore not take much action because there is because private interests are dictating and leading in this area. Is that legitimate, and to what extent can we take these agendas as being in public interest? I think this is quite a good comment and question. Just wondering if perhaps Emma, would you like to comment on that from the social contract point of view?
Yeah, I mean, I think maybe picking up on earlier comments as well, I think the idea of the social contract might not dictate exactly how companies behave in this area, but it's certainly, I think what the social contract can do for you is show you what the kinds of responsibilities that can be placed on corporations are, or placed on private sector firms are. And I think in other work, I've tried to suggest that it's not just because you have the social contract model in mind, it's not then a case that you're then leaving it up to businesses to decide how they contribute to societies. It would be the idea that, a company needs to set up a social license board, as it were, where it takes the voices of its workers and its community and the wider set of stakeholders and uses those to try and develop a statement of its social purpose and the steps that it's going to take to try and meet purpose. And then it's up to wider society, as represented by the state, to decide whether that statement of purpose and the actions that are being taken to meet it are such as to warrant a granting of a social license, as it were. Thank you, Emma. We are coming to the end of time. I just thought that maybe as a very last thing, would David Rouch, our keynote speaker for today, have any concluding comments, just briefly, in terms of addressing the audience and as well as the panelists in relation to the debate that has arisen and how you see us going forward into the future?
A very interesting and provocative debate, and thank you, Lorraine, for very excellently warming things up. I think I come back to the fact that these challenges are systemic, and that ultimately means it does require multiple actors to act in a coordinated fashion to achieve the results that we all want. And I think I agree that Lorraine has raised some really important and real issues here. But the reality that we have to start with is that investors are absolutely part of the process. Corporates and investors are part of the process that have generated these problems in the first place. They haven't generated those problems as a result of laws telling them what to do. It is their decisions that have generated those problems. And what we need to do is to get into those decisions and try to reorientate them towards the sort of sustainability outcomes that we all want. And that needs to happen right across the system. So I think, over-reliance on investors, yes, that's problematic. Over-reliance on governments, well, let me just say India and China. I think that sort of sums it up. This is a multi-actor challenge, and what legal framework for impact is doing is looking at the extent to which the law currently enables investors to rise to that challenge.
Thank you. Thank you very much, David, for the last word on this. It remains for me to thank my speaker, my keynote speaker, as well as my panel for their enlightening comments, for the very lively debate. And we take away many things to continue to think about in this highly unresolved situation, which is a work in progress. But we do not lose hope. And hope that the audience has enjoyed this. And thank you very much for participating, and thank you for your questions. It remains for me to wish you a very good evening and hope that you keep an eye out on the future events that the Centre for Ethics and Law will put up. Thank you very much and good evening.